Good afternoon, everyone. It's the 8th of July of Monday. My name is Tilani Kramasinghe. I'm the head of research for MIBG Securities, and welcome to a brand new show of Monday Market Picks. Global stocks have climbed to a record high on tailwinds of AI as well as central bank easing. But one thing's for sure, when tailwinds are blowing, entire sectors benefit from that. And we actually focus on two of these sectors this week, offshore and marine and tourism, right here in Southeast Asia. Jarek is on the line, and he's going to be talking about his latest initiation, which he says can be a multi-bagger. And we are also going to revisit Marco Polo Marine after the share's recent correction. We also have a note from Bunyakorn on airports of Thailand. Remember, this is a Singapore SGX SDR stock, and he thinks that the worst is over for this stock, and there's a golden opportunity to buy. Finally, we have Husseini, who has the latest take on Singtel after he spent some time with Singtel's management on the road meeting clients in Bangkok. If you haven't had a chance to download our latest newsletter, Riding Tailwinds, you can do that by scanning the QR code that's on your screen right now. So as always, let's start with the market movers. A lot of markets on the green last week. We had the US markets betting on increased mounting pressure on Jerome Powell to start easing there, given some of the softer job figures that came out. China, on the other hand, continues to be a drag. There's very limited market confidence there. Plus, we actually saw some commodities like oil pulling back last week ahead of some of the OPEC data that's supposed to be out this week in terms of overall crude data inventories. We saw the Jakarta Exchange and the SET in the green last week, while the STI and KLCI pulled back a bit. Now, this is a good time to bring Jarek on the show. So, Jarek, the offshore and marine sector has been enjoying quite a bit of strong tailwinds. Now, to capture that momentum, he's actually initiated on BENG Marine with a buy rating and a 47 Singapore cents target price. Stock's already up about 12% so far today. Now, Jarek, before we go into the thesis of the stock, can you give us a bit of background on what BENG Marine or BKM, what do they do?
Sure, Dylan. So Bangkok Marine, actually, they have a shipyard. So they used to have a bigger shipyard, but they sold part of it away. But they still have a remaining shipyard in Batam. So they do repairs for ships, vessels, and also they do shipbuilding as well. But now the shipbuilding business has came down quite significantly. But most importantly, they have really owned this 51% owned subsidiary called ASOM. So this subsidiary does more of repair, maintenance, and also commissioning, decommissioning, extension of life services for the FPSO sector. So this is where I would say the crown jewel is. And also, BENG has also another division that does corrosion prevention painting for vessels and also other smaller vessels as well.
Right. So the entire sort of ecosystem on the oil and gas side for vessels. Now, Jarek, you've got a very punchy buy call on this stock. What's actually driving your confidence?
Okay, so after Dynamac, we started to look into the other FPSO players in Singapore that could actually benefit from the whole sector re-rating and also the whole robust activity in the FPSO space. I think you have seen also Seatrium announcing huge FPSO orders recently, right? And also not just Seatrium, Insen, and all these guys are also benefiting. But we started to look down the supply chain, and then we realized, hey, BENG actually has this subsidiary called ASOM that is doing the maintenance and also I would say the commissioning and decommissioning as well as extension of life, for all these FPSOs. And a lot of FPSOs who are owners, they want to extend the FPSO lifespan because depreciation is almost finished, right? For the older ones. And if you can operate it for a day, you get additional $1 million of revenue. So so services maintenance have all picked up strongly, and they are willing to pay higher for such services because oil price is high. Their cost is their margins are much better. So if you pay the repair guy more to extend your fleet life, you know, you actually earn much more higher margins throughout the whole FPSO operating lifetime frame as well. So while we look at ASOM, you know, if you look at Dynamic, you know, basically Dynamic has also grown, you know, the last 2-3 years at a very fast rate. So we look into ASOM and we realized that, hey, we see the same thing. So if you look at KUANG, basically, I think 2 years ago, they were in bad debt and, you know, operating cash flow was negative. But basically for ASOM side, I think they only generated about close to $1 to $2 million of net profit 2 years ago. And as of last year, it jumped to about close to $7 to $8 million of net profit. And then this year, we are projecting about 10 to 12. Sorry, last year they did about 3 to 4 million of net profit. And this year, we are projecting about 10 million of net profit. So you can see that the CAGR, earnings CAGR is very strong. And going forward, you know, with more FPSOs under their belt, and also they are also looking to increase their labor force. I think as of this year, there were about 700 labor. Last year was about 400. And by the end of this year, they want to increase to 1,000 and also 1,005 for next year. So, you know, we look at this kind of CAGR, you're expecting, you know, I would say revenue to also grow significantly. So for us, we project about a 4-year CAGR of 51% from FY23, which is very high, you know. So we do think that this is the upcycle. It's not the end of the upcycle. It's actually closer to the start or the mid of the upcycle. And there will be much more room for KUANG to go. Yeah.
Right. So actually, that's one of the numbers that jumped out to me was 51% annual earnings growth for the next 4 years. I mean, that's some pretty punchy numbers. But, you know, the thing that I'm scratching my head on is valuations. The valuations are so low for this company, despite these very strong expectations of earnings. Is there anything else in the company's past that's kind of keeping some investors on the sideline, or do you think most of that is already done and now we are kind of in that cycle for growth?
I think most of that is already done. I mean, the company is still in the SGX watch list. That's one. Secondly, I think it's in the SGX watch list, and I think that, but in terms of balance sheet, you know, they have sold assets, they have paid down their debts, and now they are net cash. Right? And also profitability has also improved significantly. And next, in terms of, I would say, cash flow wise, they are also positive, and they are looking to give dividends, you know, by the first half year or end of this year. So I would say most of it is already over. Now they just have to get out of the watch list, which is more of a timing matter, yeah, than anything else.
Okay, so that's the key downside risk at this point.
Yes, but also there's other downside risks, like, you know, labor costs has also increased. So their margins might be impacted if labor costs continue to increase. Other downside risks would also include oil price. If oil price take a big dip down, that will impact sentiment and also impact FPSO rates. So basically, I think oil price is also one of the key indicators to look out for downside risks as well.
Got it. Okay, Jared. Now I want to, you know, move on to Marco Polo Marine. Now this stock's down about 4% in the past month. This has been a fairly high conviction stock for us. Are there any factors that's driving Marco Polo's share price weakness at this stage?
No, I think fundamentally there's no issues. I think we did some channel checks. We realized in our latest report, we also stated that the charter rates are still trending up. Utilization is very high. If I'm not wrong, utilization for Marco Polo for the third quarter should be close to 100%, which is a very, very good level, right? And because all their vessels are fully booked. Yeah, so we do think that, you know, the upcoming Marco Polo, upcoming results for third Q, they should actually report quite a positive quarter year on year as well. So yeah, I think fundamentally there's no issue, but I think it's more of sector rotation. I think money has flown from, you know, the oil and gas space to the tech space, and then now back to the FPSO, more concentrated FPSO space. But we do think that chartering is a division that will continue to do well, and we do think that, you know, eventually this space should re-rate further as well once the numbers come out.
Right. So can you kind of remind us, you got a 9-cent target price on this stock and a buy call. What's kind of going to get the stock to go there?
Sure, I think earnings will be one of the key drivers. And if you look at Marco Polo, they also have the CSOV, which they are building for the past 2 years. That should come on board in October. And once that come on board, you will have a jump to your earnings by 20%, right, for the next year. And going forward, they are also adding a few. They also signed a CTV agreement with Siemens Gamesa, and the first CTV is already operational in Korea as we speak. And they are looking to add one more CTV by the end of this year. All in all, they are looking to grow this CTV fleet to about 10 to 15 in the next 3 or 4 years. So that is also another growth angle. Next, we are also expecting Marco Polo to actually win another CSOV or SOV, kind of vessel contract, about 3 years to 5 years service length for the contracts once they are done with this CSOV. So basically the growth, going forward ahead for Marco Polo looks very bright, especially in the wind farm sector. And they are I would say, one of the first movers in the region, especially Singapore or even Malaysia, even Southeast Asia. They are one of the first movers for this space. So we do think that they will likely continue to benefit from its key relationship with all these key customers like Siemens and also Vestas. And next, I think that going forward for Marco Polo, they are also looking to IPO their Taiwanese division. So if you look at valuations in Taiwan, they are all trading above 20 times. So if Marco Polo can raise money through the Taiwanese route, then that would actually sort of put a value towards the Singapore entity as well, because Singapore is trading at below 10 times. Yeah, so we do think that all these catalysts could re-rate Marco Polo closer to my target price in the next, I would say, 6 months to a year.
Okay, so just keep the faith. I think investors, this is a very good opportunity to relook at this stock, especially given where valuations are. Thanks, Sharik, for joining us.
Thank you.
Now, stepping over to the land of smiles, Thailand, our analyst Bunyakorn says that the recent share price weakness in airport of Thailand is the time to buy. He's not online today, so I'm just going to quickly run through his thesis. The stock is down mostly on 3 combined headwinds, according to him. The first is loss-making regional airports have been consolidated under AOT, so that's actually has impacted some earnings a bit. Second, there has been some reduction in duty-free space, lowering revenues for AOT. And there has been some talk that the government may look to abolish on-arrival duty-free shops. So that's brought some negativity towards the stock. Now, but we think a lot of that is already in the price. What's more, we are now entering the high season in terms of international passengers arriving to Thailand. So earnings should actually be accelerating. AOT had some cost pressures in the first half, particularly from depreciation and labor charges. A lot of that has been resolved, and we don't expect a continuation in the second half. And I think the key is this: Thailand tourist arrivals are expected to overshoot the official targets in 2024. Every 1 million more tourists coming into Thailand above the target will add about 3% to AOT's earnings. So quite chunky. Plus, there is this potential for more passenger levies to be imposed going into 2025. So that can also add to the revenue. Also look at how the stock trades. Typically, the stock starts to re-rate and trade up in the second half of the year. The only times that it hasn't actually done that was in 2021 and 2023. So I think right now there is a trading opportunity for AOT. So do have a look at that. I also want to remind you that this is a stock that you can trade directly from the Singapore Exchange, given that it's an SDR. Now, let's jump to big caps and Singtel. As you know, this has been one of our big conviction stocks for a while. And I always say that hearing from the horse's mouth is the best sort of market intelligence you can get. And it so happens that Hussaini has been spending some time with Singtel senior management down in Bangkok, meeting some clients. Hussaini, what's been your biggest takeaways for Singtel from your roadshow in Bangkok?
Yeah, sure. Thanks, Chilan, for having me. We hosted Singtel management on a non-deal roadshow in Bangkok. Three key takeaways. First, potential mobile consolidation in Singapore. Now, if you see, Singapore is a small market with 4 mobile operators and 11 MVNOs. So management, Singtel management thinks it could happen, the consolidation could happen sooner than later, especially ahead of the upcoming 700 megahertz spectrum payments. Now, based on our experience of the regional markets, consolidation helps in softening in competitive intensity in the market. So that remains one of the catalysts in our view. Now, the second, management was highly positive on Optus. Optus turnaround in Australia. Optus, if you recall, Optus was one of the main pain points for Singtel. Now, management noted that Optus raised prices by around 5 to 18% in May earlier this year. And management was of the view that the price increase were very well taken by the consumers. So they haven't seen much churn on the back of that. Also, as Optus rationalized few of the operations, management noted that it is helping in cost savings. And management also noted that capex for Optus has peaked and is on a downward trajectory. So net management is eyeing for Optus ROIC to hit the levels of its peers or Telstra, which is high single digit versus 1% as of now. So a significant turnaround management is seeing in Optus. And third and final, which is more important in my view, is the dividend clarity. So management noted that it is around $2 billion or Sing dollars from the previous capital management or capital recycling on the balance sheet. And they are also looking to recycle 6 billion on top of that. So in total, 8 billion in dry powder, in my view, which could be diverted as dividends. So what management noted is that they are in a very comfortable position to pay at 70 to 90% as regular dividends, 70 to 90% of earnings as regular dividends. And on top of that, they can pay 3 to 6 cents in value realization dividend. So if you add up all of this, it gives around 6% dividend yield. So that was the third key takeaway.
Got it. So some very positive takeaways. So how does this all kind of come back to your thesis on the buy call on this stock? Are you more confident?
Yeah, means I'm super confident of Singtel, and it had been I haven't seen management that bullish on the company, on the overall operations in the last many years. So yes, we do reiterate our call. I see companies fighting on multiple cylinders. Okay, so potential Singapore consolidation, mobile consolidation, and Optus turnaround is positive. Companies taking big strides in data centers, which is again positive, especially with all the emerging AI-linked use cases. Singtel's associates are also in good shape with stable to improving competitive intensity in various markets like India, Thailand, and Philippines. Now, just to recall, in India, its associate Bharti Airtel just raised pricing by around 10 to 21%. So a big increase in pricing in India, which in our view will help significantly at Singtel level as well. Now, on top of all these things, there is value as well. So Singtel is trading at around 40% holding company discount. And this is despite the recent re-rating in the stock. Okay. We expect company to deliver 15% earnings CAGR and offer 6% dividend yield. So I remain super confident on Singtel.
Great, that's great to hear. So do take a look at Singtel. Now, let's quickly move on to our chart guys, latest charts this week. He's covering mostly the tech sector. We got trading buy on NANOFILM, where the stock broke through its medium-term downtrend last week. We also have a trading buy on AZTECH Global after it also broke through its downtrend channel. So some interesting technical charts out there. So do take some time to go through that in our newsletter. Now let's jump into our upcoming events. Quite a few events coming up. Just one of the events I want to highlight is the GDP growth numbers out on the 12th of July. It should be not May. But one of the things that I want to kind of highlight is there's a question from the audience. Should the GDP print, how should the GDP print later this week influence my approach to stock picking? One of the key areas I think we are watching out for is manufacturing GDP. We did see that coming off, but we did see last month GDP starting to pick up some steam on the manufacturing side. And if you look at Singapore, a bulk of manufacturing is electronics exports. So I think if we do have a turnaround there, that will be quite positive for quite a few of the electronics names, AZTECH being one of the beneficiaries from the technical charts, but also one of our top picks is Franken. So do have a look at that as well. Apart from that, let's have a quick look at upcoming events. We've got a great event that's coming out on Thursday, Discovering the Undiscovered. This is a live event at SGX. We actually have Ben KUANG, CEO there, but we also have Kerry Mock from SATS, and as well as Centurion as well. And you'll also get a chance to hear from very veteran journalist Ben Srinivasan as well. So if you haven't signed up, please sign up, use that QR code there. Spaces are very, very limited. Thank you so much again for joining us this week. And as always, thank you so much for continuing to support us. And I am going to be on a break for the next couple of weeks in July, but you will be in the good hands of the golden voice of Seng Yao Ong. So please do join us next week. Thank you.